Good morning, everyone. Thanks for joining the weekly research morning call. Today we have quite a few stock content updates, highlights of the latest FOMC meeting, and the Euro technical pulse and Singapore weekly. So without further ado, I'll hand over to John to begin today's webinar. John, please.
Thanks, Mel. And good morning, everyone. So I'll be running through Apple's fourth quarter results that was announced last Friday. Overall, their results were in line with our expectations, with fiscal year 2023 revenue and PATMI at about 101% and 100% of our forecast. In terms of what really were the positives, the two main positives: firstly, services grew 16%, and so that was the main highlight. And secondly, China and India remain huge opportunities for iPhone sales, which remain fairly resilient. So in terms of these services, so this essentially is like your Apple Care, your Apple Pay, Apple TV, and so on. The company actually saw kind of an acceleration in year-on-year revenue growth. So if you think about it, from the third quarter, growth was only about 8%, whereas it's 16% this quarter. Mainly because as more and more people purchase Apple devices, services tends to benefit because of a higher installed base. A lot of Apple users are very loyal customers, and the switching away from Apple products is very low, and actually more and more people are using more Apple products. So essentially, if you have more products, which is your installed base, currently there's about 2 billion active devices. Generally, you would start to see services continue to at least grow in terms of their revenue. Out of these 2 billion active devices, there are about slightly over 1 billion paid subscriptions. So it's a very relatively high conversion rate in terms of transacting and paid users compared to I guess just your installed bunch of users. And so we think that moving forward, this should continue to at least push Apple in terms of overall revenue growth. Even though services right now is only about 25% of your total revenue, we think that slowly, as the other segments kind of stagnate, services will be a larger contribution moving forward. In terms of iPhone sales, iPhones, revenue grew about 3%, which is not that significant, but there were some headwinds due to FX, and unit sales were actually fairly resilient compared to some of the, I guess, initial worries over demand for a lot of tech hardware, including smartphones. And so a lot of the sales was driven by demand from India and China, especially in China. In terms of China, there were record fourth quarter iPhone sales, and they're actually gaining market share in China because the overall smartphone market there actually contracted a little bit. So right now it's estimated that they have about 18 to 20% market share, which makes it essentially the largest smartphone player. It's very tight. There are quite a number of companies like Oppo and Vivo, I believe, and Huawei that are around the same 16 to 20% range. So it's very stiff competition, but based on what we saw in the fourth quarter, they are still kind of gaining ground. And so there's definitely one of the other positives. In terms of the negatives and the outlook, there's relatively weak outlook for everything other than services and iPhones. So when you look at the other products like your Mac, your iPad, as well as your wearables like your Apple Watch and so on, there wasn't much to shout about in terms of results for this quarter as well as for next quarter moving forward. The expectation is still that products will be more of a drag than a tailwind, and this is mainly due to cyclical headwinds from weakness in demand for some of the products. Mainly because it's very rare that you get people buying these kind of new products every year, and generally as a whole on the whole tech hardware market, they're seeing quite a lot of weakness, and they expect to see continued weakness moving forward. We do think that gross margins will inch higher slowly, mainly coming from services, as services starts to contribute more and more as a total percentage of revenue, mainly because services gross margin is like 71%, whereas you compare it to your products, which is basically half of that. So as services starts to contribute a little bit more, your overall gross margin should expand moving forward. which is one of the reasons why we actually upgraded from a neutral to an accumulate rating, with a raised target price of 194 US dollars. Mainly because we also forecasted another year. We raised our 2025 revenue and EBITDA by about 5% on higher services as well as normalizing iPhone growth. So with that, I'll move on to my next counter, which is AMD. AMD also announced their earnings last week. In terms of how they did, their revenue was within our expectations, but earnings was actually, I guess, quite a significant disappointment for us. But that being said, because they are relatively, close to break even and slightly positive, slightly negative, a couple $100 million dollars actually makes a significant difference in terms of, just percentage wise. In terms of what was good, so AMD has four main segments. Each of them actually contribute about this, roughly about the same percentage of revenue. So if you got your data center, your client or your PC segments, as well as your gaming and embedded segments. So two did well and two really didn't do so well. The two that did well was PC and data centers. So when you look at PC, it was the main standout. They saw like 42% year-on-year growth. There were a couple of reasons for this. Firstly, there was a very low base compared to the third quarter of last year. So you see this huge jump in terms of year-on-year growth. At the same time, the AMD's new Ryzen 7000 series CPU is actually gaining a bit of traction, which is actually quite positive because we are starting. It is an early indication of a PC a recovery in the PC market, especially as some of the inventory has normalized a little bit. So essentially, over the pandemic, there was quite a buildup of inventory for a lot of these hardware, and a lot of your I guess a lot of AMD's end clients, over the last year, they haven't really been purchasing that much because they had such a backlog. What we're seeing right now is that inventory levels has come down, and so a lot of their customers are actually starting to buy their products again. And when it comes to data centers, the main big thing would be surrounding generative AI. So what AMD has been doing is been improving its GPUs that are used for generative AI. So essentially, they're trying to compete with NVIDIA. And I guess the plus point for them is that because AMD's GPUs are extremely expensive, so what AMD has, because NVIDIA's GPUs are so expensive, what AMD essentially has done is it's created a slightly inferior product in terms of performance and efficiency, but they've also priced it a lot lower so that it attracts a lot of your maybe not so large enterprises that aren't willing to spend so much money on NVIDIA GPUs, and they're looking for alternatives. And so you've got this flow through demand from I guess customers that are looking for something that's maybe not so high performing. And so this is expected to right now it only contributes maybe 300-400 million in terms of overall data center revenue. So it's not really that significant. But moving forward, the expectation is that they're going to do about around 2 billion in revenue for just your data center CPUs for next year. So for next year, it should be a significant, I guess, contributor compared to everything else. In terms of what were the main negatives, like I mentioned earlier, it was predominantly gaming and embedded. Gaming essentially is all your CPUs and GPUs that are in your gaming consoles, like your PS5, your Xbox, and so on. And why it was weak, it was because I guess usually there's this life cycle of consoles. So right now, they're in their third year of your new PS, or rather the third year after the PS5 actually it was introduced. So naturally, as the years go on, you see demand for consoles kind of continue to weaken and continue to decline. And so that's generally what we're seeing in the gaming segment. In terms of embedded segment, embedded means your chips that are in your refrigerators, in your washing machine, in your TVs, stuff like this. This also has continued to decline, mainly because these kind of segments are fairly cyclical, and consumer demand for a lot of your tech hardware, similar to Apple's other products, remains fairly weak, and it's not expected to really pick up that significantly in the near term. The other negative is that there were slightly higher R&D expenses than we forecast, mainly because they're continuing to invest in some of their tech infrastructure. At the same time, there's expectation for $550 million US dollar tax impact in the fourth quarter of this year. And this was mainly a deferred tax that the company had because of wildfires in California, I believe last year or either the year before. So they'll be having to have this tax expense in cash in the fourth quarter, which we didn't account for, and so it really dragged down our estimates for this year. Why we downgraded from an accumulating neutral is mainly because out of the four segments, you've got two that are doing well and two that remain quite significant drags. And we think that it'll be very difficult for overall revenue to grow as well as overall margins to expand if you've got basically half your businesses anchoring you down. And so we actually cut our 2023 and 2024 EBITDA by 11% and 14%, as well as cut our PATMI for this year by about 1 billion. So right now we are forecasting AMD to be roughly break even for this year. In terms of the 9 months performance for earnings, this year they're up around 300 million. So we expect some losses in the fourth quarter to come, mainly because of the tax impact. And so that's why we downgraded from an accumulator to a neutral. We also cut our target price from $121 to $110. So that's all for my counters. I'll hand it over to Ambrish for PayPal. Thank you.
Thank you, John, and good morning, everyone. So we released PayPal's third quarter results report this morning. So overall, the results were within our expectations, with the 9-month revenue and adjusted PATMI at 74% and 73% of our full year forecast. So in the third quarter, PayPal's total revenue, it grew by about 8.4% year over year. And PayPal is basically a fintech company, and it generates revenue by charging fees on its total payments volume on its platforms. So moving on to the positives, the total payment volume for PayPal, it grew by about 15% year over year to $388 billion US. And this was mainly because of resilient consumer spending on its platforms like Braintree and Venmo. And it's also trying to monetize the Venmo platform by introducing it as a payment option on Amazon. So even going forward, we believe that it should contribute to the higher payment volume for PayPal. And secondly, it's currently focusing on increasing its user engagement within its existing base rather than focusing on adding in new users. And this strategy, it has been paid off mainly because the number of transactions per active account, it grew by about 13% year over year. So basically, the number of transactions, it increased per user. And because of this strategy, the number of active users, it dropped by about 1% year over year to 428 million customers. And this was mainly because of the churn from the lower quality customers. And so moving on to the negative, secondly, the gross margin, it has contracted from like 51% previous year to 45% in this quarter. And this was mainly because the management highlighted that the strength came in from Braintree unit, which is a lower margin business, and this dragged the gross margin. In terms of outlook for the fourth quarter, total revenue, it's expected to grow by about 7.5% and earnings to grow by about 10% year over year to $1.36, mainly driven by higher operating leverage. And we expect the gross margin to further contract mainly because of the business mix shift towards Braintree. And overall for PayPal, we have maintained our buy recommendation and slightly increased our target price to $101. And this was mainly because we increased our EBITDA by 1% to account for lower expenses. And overall, we believe that PayPal, it's well positioned mainly because it has a strong user base of 428 million. And it has a global presence across the countries. And it should benefit from its two-sided network as it serves both customers and merchants. And it should benefit from the shift to cashless payments. So that's all for PayPal. Moving on to my next stock, which would be Airbnb. We released Airbnb's third quarter results report last week. So overall, the results were exceeded our expectations, like 9-month 2023 revenue and adjusted PATMI came in at 79% and 91% of our full year forecasts. And this was mainly because of the continued travel demand and higher operating leverage. So for Airbnb, the total revenue, it grew by about 18% year over year. And this was mainly driven by a surge in its booking volumes and the daily rental rates. And also there was a 4% tailwind from foreign exchange currency. So moving on to the positives, the company, it reported booking volumes growth of about 14% year on year. And the key travel trends would be that the international travel is picking up, like it posted cross-border trips, booking volumes, they grew by about 17% year over year. And this was mainly in the Asia Pacific regions. Secondly, the guests are returning back to cities, and the bookings into the urban cities, they grew by about 15% year over year. And guests, they are staying longer for like 28 days or more. And this represented 18% of gross nights booked in the third quarter. So approximately 20 million bookings were for long-term stays. Secondly, the listing supply on the Airbnb platform, it has been consistently increasing. Like for the first for 9 months, in the first 9 months of 2023, it had added about 1 million listings, and in the third quarter, they grew by about 19% year over year to over 7 million. And we believe that was mainly because of continuous product enhancements and marketing and providing support to hosts. Like in May, it had introduced 50 plus features, like which included Airbnb rooms, monthly stays, and pricing tools. So with the continuous product enhancements, the listings have been growing. And also, secondly, hosts, they might turn on to Airbnb to earn an additional income. So moving on to the negatives, the company, it provided a cautious fourth quarter outlook. So like it expects its revenue to grow by about 13% year over year. And this is a decline from the third quarter revenue growth rate. And it expects booking volumes to moderate sequentially, mainly because of higher volatility. It expects the travel demand to be impacted mainly because of the geopolitical tensions in Middle East and also macro uncertainties. And lastly, it expects the average daily rates for the fourth quarter to be stable or slightly higher, mainly because of a business mix shift towards larger and higher priced properties. So overall for Airbnb, we have upgraded the stock to buy mainly because of the recent drop in its stock price. And we have increased our target price to $157 from 152, mainly because we have increased our revenue and EBITDA estimates by 2%, mainly to reflect high average daily rates. And overall for Airbnb, we believe that it should benefit from shift to alternative accommodations, and it's more family and group travel friendly. So that's all for me. I would now like to pass on to Sean for FOMC highlights.
Yep. Thank you, Amrish. Yep. I'll be running through the meeting highlights that happened on the 1st of November last Wednesday. So last week, the Federal Reserve have decided to maintain the federal fund rate for the second time at a range of 5.25 to 5.5%. As they expressed, they did observe some signs of moderation on inflation, while also acknowledging that the tighter credit conditions, such as the increase in treasury bond yields at the home mortgage rates, are placing a burden on the economic activities. But although this recent inflationary data pointers, such as the PCE and the CPI index, which is the Fed preferred measure of inflation, has continued to show signs of moderation since June last year. I mean, they are still hovering above the 2% targeted range, with the latest total PCE and core PCE for September coming in at 3.4% year on year and 3.7% year on year respectively, which is a slight decrease from August at 3.4 and 3.8%. While similarly for CPI, the latest headline CPI and core CPI for September came in at 3.7 and 4.1% year on year, which also shown a slight decline in the results. So in terms of the guidance, not much was shared during this meeting, as the dot plot graph was not available in this FOMC meeting. The next dot plot graph will be available in December. And as mentioned earlier, although that in this meeting, the committee did state that they do see the recent inflationary data pointers are coming down, Jerome Powell has also mentioned that because of a few months of positive data pointers, this is still insufficient, and a period of below potential growth and some softening of the labor market condition will be required to have a more meaningful guidance in terms of what direction the monetary policy should take. So I mean, to conclude, it appears that the last additional rate hike for this year that was projected in the September's meeting will be unlikely given the recent welcoming data pointers, as well as the tighter credit conditions, which will aid in keeping inflation in check. However, as always, do note that the possibility of further rate hike increases has not been taken off the table, as it was mentioned on several occasions that if inflation were to trend even higher, then the committee member is prepared to raise rates even further if appropriate. So that's all I have for the meeting. With that, I'd like to hand over the time to Darren to talk about CapitaLand Ascott Trust.
Yeah, thanks, Sean. Yeah, so CapitaLand CLAS, they released their third quarter results, or rather the business updates. So for the results, the RevPAR grew 17% year on year to $154. So it's still trending upwards, and it's really reached pre-COVID levels at 102%. Yeah, so Singapore, Australia, US, and UK, Japan are all already at pre-COVID levels for their RevPAR, and China and Vietnam, even though it's still slow, China is slowly picking up. Is not right now it's at 80 and about 84% of third quarter 19 levels. But as you can see in the left-hand side chart, yeah, it's also growing. Right now, China year on year it grew 9% and Vietnam grew 22%. So CLAS also has a resilience from the stable income sources. So they have a split of stable income sources and their growth sources. So 7 of their master leases, which were due in 2023, they're renewed. So they're renewed at about 28% higher rent. So under this new structure is based on either a fixed or variable component. But then because of the next year in France, especially like there's the Olympics, so the demand there is very high, and we expect from the variable component that based on current rents, it'll be 28% higher than current rents. So right now their rental housing is also 95% occupied. And Standard in Colombia, which is their student accommodation development in South Carolina in USA, it completed and it received its first batch of students this year, or rather in August 23 this academic year. And right now it's about 90% occupied, and we expect that the fourth quarter will be the first full quarter contribution from Standard at Colombia. And for CLAS, right now their cost of debt is at 2.4%, is unchanged year on year. It's unchanged quarter on quarter, sorry. And right now they also have 83% of their debt that is on fixed rate. It was 80%, but it's up because they paid off some of their debts using the equity fundraising funds. So their gearing also it fell because of that. Because right now they raise funds, but the payment is not yet due. The payment is around fourth quarter. So as a result, they instead of letting the funds just sit around, they used to pay down some of their higher interest debt, which is why the gearing also fell. And the ICR remains healthy at about 4.2%. So next year in FY24, they have a sizable chunk of their debt that is expiring. So we expect that debt cost to increase to about 3% next year. And yeah, for the outlook, forward bookings still remain very healthy for fourth quarter. And international visitor arrivals will continue to pick up as all the airline capacity increases. So this will help them in all their properties. And they also have about 300 million of divestment gains that are still sitting in the books that they have yet to pay out. And the management, they have said that they will pay out partially to help to cover the Cavendish London, which is one of the properties that they are going to acquire in the fourth quarter. Is going to go under AEI or renovation in the fourth quarter of 2024 to about to the end of 2025. So while it's being closed, management have indicated that they will use this part of this divestment gains to help to mitigate the impact of the loss of income. So they will make it as if the Cavendish London was still being in operations by paying off this divestment gains. And with that, we upgrade our call from an accumulate to a buy call, but our target price is lowered mainly because of the equity fundraising exercise they did earlier. We saw the share price drop quite a bit. So right now our TP is lowered to $1.04. In our estimates, we put in the the acquisitions as well as some of the divestments that they did recently, as well as higher interest expense, and we accounted for the higher share base from the equity fundraising exercise. So in all, after the EFR, their share base rose by about 9%. Yeah, and right now CLAS is trading about a forward dividend yield of about 6.3%. Yeah, so that's all for CLAS. I'll move on to Manulife US REIT. Yeah, so Manulife US REIT, they issued their third quarter business update last week, and then after that, we also had a poems webinar that we hosted. So Manulife US REIT, most of you already know, is a Singapore listed US office REIT. Right now, it's traded about 100 million market cap. And some of the portfolio highlights. In third quarter, their portfolio occupancy dipped slightly quarter on quarter at 84.7%, but they managed to have some very good rental reversions, positive 24.2%, but that's mainly because of the Patrick Townsend, which is their fourth largest tenant. As you can see on the bottom right, the picture of their top 10 tenants. Yeah, they signed the lease at high reversions. And for their capital management, the cost of debt, it increased quarter on quarter slightly. And their fixed rate loans, it dropped from 80.2% to 69.2%. Yeah, so this, just a quick recap. Because Manulife, they hit their unencumbered ratio, they breached the covenants of 60% previously. So now all of their loans, as you can see in the top right corner, that is the original debt maturity profile. But because of the breach, all of their loans are now classified as current liabilities. And as a result of all these loans becoming current liabilities, the interest rate swaps, there's a cross default on them as well. But then because there's a cross default and so they are right now they're in discussion with the banks because of the cross default, but the banks are still honoring that their end of the interest rate swaps. So as a result, 10% of the IRS, the interest rate swaps, they fell off over the quarter, but they're still honoring the remaining 69.2%. But what they mentioned that is that they are no longer giving any new interest rate swaps. So going forward, the swaps are likely to continue to fall off. Yeah, and right now their ICR is at 2.4 times, and this means that their MAS gearing leverage limit will be capped at 45%. But that doesn't really affect them now because their MAS, their leverage is already at 56%. Yeah, and as I mentioned previously, that they already secured early renewal of their fourth largest tenant. And just a quick run through of their top 10 tenants. The William Carter is at Phipps. They re-signed earlier this year. And the TCW Group is their second largest tenant is in Figura, LA. So that's one of their weakest property location and weakest asset. So that's Figura is also one of the assets that fell the biggest. The valuation decline was the highest of over 20%. So the lease expiry of this TCW Group at this location is at December 23. And management are trying to backfill this space, but it's very challenging at that area. And the Children's Place, they also exercised their lease break clause. So their lease expiry has been pushed forward to May 2024. And they also received some lease break incentives or money from the lease break. And the management are in discussions, and funny enough, they are also in discussions with the Children's Place as well, even though they indicated that they want to break the lease early. But right now, after they indicated that there are still discussions with them, they are one of the tenants that management are in discussion to backfill their space. Yeah. So right now for Manulife, they are negotiating with the lenders to formulate a long-term liquidity plan. So this will encompass a sponsor support package, which will help to solve the liquidity issues. And it's not just for the 2024 and 2025 debt maturity profile, is more of like the whole package, which is why it's also taking such a long time. And the execution will all depend on the lender's approval. And on top of that, they're also having a disposition mandate, which will help them to dispose of the assets faster. And part of this sponsor support package, we think that might be disposition of some of the lower or not so core assets, because right now, originally Phipps was part of the plan to divest to the sponsor Phipps, which is one of their better assets in Atlanta. Atlanta, Phipps, and Peachtree. So these two assets right now, yeah, they are kind of the better properties in Manulife US REIT, and the lenders also, they do not want to see that these two are the best assets being divested. So they also like to have this some of the better assets stay in the portfolio to collect rental from there. Yeah, so we think might be the divestments might be some of the lower non-core assets. And to show the sponsor support, they also the sponsor has appointed the global head of real estate to be the board chairman of Manulife US REIT, Mr. Mark Feliciano. Yeah, and for the outlook for Manulife, US office transactions are still muted. It's down 69%. The main issue is because the US banks are no longer lending much money to, or rather, there's a liquidity crunch, so they are no longer lending for funding. And the physical occupancy is still quite weak for Manulife's properties. Right now, it's only at 40%. It's up 8% year on year. And we also expect further downward pressures on valuations, but the impact might not be that great because they have already done some valuations over time and mid-year. So as compared to some of the other US REITs where they only did a full year, so we expect a lesser valuation decline for Manulife based on that, because they already took into consideration a mid-year valuation. And right now for them, leasing volumes are still slow. Yeah. So we also hope that they can complete this sponsor support package and come out more with some of good news by the end of this year. Yep, so that's all for Manulife US REIT. I'll now hand over time to Miao Miao. Thanks.
Thank you, Darren. We did Phillip on the ground for Paragon REIT. It's a commercial REIT in Singapore and Australia with 5 assets, including Paragon, Clementi Mall, and the Real Mall. So in third quarter 2023, gross revenue increased by 1.2% year-on-year to 215.6 million. Revenue for Singapore and Australia asset increased by 2.4% and 5.4% respectively. Portfolio occupancy increased by 0.3% year-on-year, driven by higher occupancy at Westfield, but partially offset by lower occupancy at Fig Tree. While occupancy for Singapore asset remain unchanged at 100%. Management shared that reversion for its Australia lease renewal since first half 2023 continue being negative, but was recovering. Since around 4% of the lease by rental income will expire in FY 2023 at Australia site, rental reversion is likely to be flattish for the next quarter. Reversion for Singapore is more likely to be positive mid-single digit with tenant retention ratio of 70 to 80%. Gearing remained low at 30.1%, and Paragon has 300 million in perpetuals to call next year, August. Assuming interest rate remain at the present level, the coupon rate will increase from 4.1% to 6%. In the case of refinancing all the perps through the loan, gearing would increase up to 37% after refinancing. They also conducted a half-year asset valuation. 31 million fair value loss of its Australia asset was recognized. The valuation decline was partially attributed to a 25 basis point cap rate expansion for both Westfield and Fig Tree Group. The management foresee overall of 45 basis point cap rate expansion at the year end, and Singapore side mainly remain unchanged. They also observe a slowdown in consumer spending in Singapore. We expect occupancy costs to trend down in second half with the return of Chinese tourists, as the luxury products are generally 10% cheaper in Singapore compared to the mainland China. As for the outlook, overall, Paragon has a balanced mixture of suburban mall and tourism spot. We are generally positive on the REITs due to its robust balance sheet and inorganic growth potential. We also expect to see more positive rental reversion from Paragon in FY 2024, as the lease was signed during the pandemic. Reversion at Clementi Mall or Real Mall is likely to decline. Yeah, that's all for Paragon REIT. I'll hand over to Zing for technical costs.
Thanks, Mel. I'll move on to the technicals. So looking at S&P 500 last week, we saw a retest of the main uptrend channel following a breakdown the week prior to that. So given the sharp rise we saw last week, which was about 6%, we are likely to see some form of consolidation going ahead. Since we're also quite near some near-term resistance, which was a range level that we saw prior to the breakdown. So for the resistance wise, it could be at 4,370 to about 4,430, or the support could lie at 4,260 to about 4,315 area. Next slide. Then in terms of technical monthly for October, to summarize, the downtrend is currently underway for most of the assets, but we could expect some sort of rebound in terms of US equities and bonds. To recap, in October, most of the asset classes were down about 2 to 4%, with the outliers being gold, which gained about 7%, and Bitcoin, which surged close to 30%. So in terms of the outlook for this month, for S&P 500 as well as US Treasury bonds, they could break out of their current downtrend, since they actually touched some of the near-term supports, and some form of rebound is actually likely given some technical indicators. As for gold and Bitcoin, they could continue their bullish momentum if they hold their respective support levels following some period of consolidation. As for the remaining asset classes, which are oil, Singapore equities, as well as Hang Seng Index, some weakness is likely to continue into November with a weak price action for these asset classes. Next slide. So the first one is, I'll go into detail, will be this Vanguard S&P 500 ETF VOO. So in October, we saw the breakdown of this main uptrend channel. So likely the mid-term uptrend is actually nullified for now. We also dip into correction territory, dropping 10% from the peak in end July. But however, we actually retested the 380 level, which was a strong resistance in the middle of this year. So like when we saw this acted as a support last week, and we actually rebounded back. So for November, I'm expecting some sort of consolidation. But probably we won't see a lower low coming in for now, but probably just some consolidation, given that we are still in downtrend for now. Next slide. The next one will be the 7 to 10 year Treasury bond ETF, IEF. So for this, it has generally been trading in the downtrend, in this downtrend channel over here ever since it broke down of the bearish flag. But in October, there were some potential bullish signs. There was a retest of the support around the $89 level. And then this was coupled with bullish divergence on the RSI as well. So with that, as well as the decreasing the bond yields, we could see some sort of rebound in terms of this Treasury bond ETF in November. Next slide. Then moving on to the Gold Mini Shares Trust, GLDM. So there was a trend reversal that took place in October. We actually broke out of this downtrend channel over here, and actually we cleared some resistance, some horizontal resistance levels on the way. Currently, we are sitting at about $39.50 level. Potentially, we could see some form of consolidation given the strong gains of about 3 weeks that took place. So for gold now, still looking good, as there's also a fresh bullish crossover in terms of the MACD. Next slide. And the next one will be the oil and gas exploration production ETF, XOP. So for oil, it has generally still been trading in a range. So we expect that to continue, but with a bearish bias, since that we're also seeing some a fresh bearish crossover in terms of MACD. So there's a lack of momentum currently for oil ETF. Next slide. Okay, then Bitcoin was the biggest gainer in October. We actually broke out of the downtrend resistance line and actually surged to a new high for the year for this Bitcoin strategy ETF BITO. So currently we actually tested the resistance around the 1760 level horizontal resistance. So potentially we could see some sort of consolidation first before price could actually trade higher. We also saw a fresh bullish crossover at MACD as well. Next slide. Okay, as for Singapore equities, after a very long period of range trading, consolidation in this rising wedge pattern for this year, we actually had an important development in October, which was the breakdown of wedge that took place. So we actually retested a support level at around 313. And I think with that, we also see increasing bearish momentum at MACD with a lower low. So actually that gives us a bearish outlook for Singapore equities ETF. So potentially we could see some bearishness ahead, with resistance around 322 or 327 if we were to test the range breakdown area. Next slide. Okay, then for the Hang Seng China Enterprises Index ETF 2828, currently it's still, there was also a breakdown of the range, a key support level of the 6650 level in October, and we are still resisted by the downtrend resistance line. So until that, price is likely to just consolidate in a bit of a range unless we see a breakout and reclaim above the 6650 area again. Then potentially there's some strength back in the Hong Kong markets. Next slide. Okay, then moving on to the Thai SDRs, which are Airports of Thailand, CPO, as well as PTT Exploration and Production. In October summary, they were all down between 4 to about 8%. The biggest loser was CPO. Yeah, and then to sum up, all three of them are currently just lacking momentum. We could see for November, we could see some range-bound trading taking place for probably Airports of Thailand as well as PTT. But CPO is likely to see more downside as it actually just broke the key support level, and there's also weak momentum. Next slide. And so for Airports of Thailand, a key development was the breakdown of this rising wedge, similar to the Singapore equities ETF, which I discussed earlier just now. After a long period of range, we actually saw a breakdown. Actually, price tested the $65 support level, the swing low in March of this year, I think. Yeah, so with that, potentially we could see a bit of a range consolidation take place for AOT for November. Yeah, but expect strong resistance around the $70 level, which was the fresh breakdown area. Next slide. For CPO, there was a breakdown of the key support level, which was at around $60 to 61 level over there, after we formed lower highs throughout this year. So with that, we're likely to see this bearish momentum continue, especially when you see the MACD posting fresh lows. Yeah, also could possibly go and retest the $52 swing low, which actually acted as a key rebound area as in the chart. Yeah. Next slide. So the last of the Thai SDR will be PTT. This is actually one of the strongest one compared to the other two. So it's still actually in October, it just continue to consolidate and range. The recent resistance at $173 is still acting as a resistance. But there's a slowdown in bullish momentum recorded on the MACD as well as RSI, see lower high being formed. So potentially we could see this consolidation drag on in November. Yeah, with that, that's for the high SDRs. Next slide. Okay, then I'll move on to the individual counters that we initiated trades on last week. So for American Airlines Group, it's a technical buy at $11.15 with take profit level at $12.25 as well as $12.75. Stop loss at $10.60 and the stop loss closed at $11.98 on Friday. So for the trade idea for American Airlines is that there was a breakout that took place of the downtrend channel. And after finding support at the $11 area, where it actually just sideways and found support over there, which was a previous strong support from July to October in 2020. We also saw bullish divergence on MACD and RSI with a fresh bullish crossover on MACD recently. So potentially with that, price actually just managed to break out, and we could potentially see price go on to retest these two resistance levels in the near term. Next slide. And the next trade idea would be Netflix. For this is a technical buy, $420.19. Take profit levels at $437 as well as $448 with a stop loss at $404. The stop loss closed at $432.36. So for Netflix, there was a breakout of this downtrend resistance line after a period of range consolidation after the earnings release. The good thing was that the $396 level, which was a prior horizontal resistance, managed to act as a support upon the retest, and actually price managed to form a recent higher high with increasing momentum as well. So potentially price could want to retest these two levels, which was the range area which we saw in September prior to the breakdown. Next slide. As for Fraser's Logistics and Commercial Trust, it's also a technical buy at 108. Take profit levels at 116 as well as 120, with stop loss at 103. The stop loss closed at 111 on Friday. So for FLCT, it was a breakout of this descending wedge, coupled with bullish divergence on MEC RSI with a higher high being formed on MEC. So there's momentum actually picking up. So potentially we could see price go on to test these two resistance levels, which was also the 50% and 61.8% Fibonacci retracement levels. Yeah, that's it for FLCT. Next slide. So for last counter, we initiated a trade on will be Super Micro Computer. So for this is a technical sell stop. If price actually breaks down below $227.30, the profit could be at 123 as well as 168 with stop loss at 254. So this trade idea wasn't initiated yet as price didn't actually break down. It last closed at $155 on Friday. So in general, the broader trend is that there's actually a head and shoulders pattern actually forming with decreasing momentum on the technical indicators. So should it break down the neckline support as well as the horizontal swing low support in September, which is the $227, $228 level, potentially we could see this breakdown of this bearish pattern to revisit some of the support levels we saw back earlier this year. Next slide. Yeah, so this is my last slide. This is actually just a summary of the 4 trades that initiated last week. So in general, the 3 trades are actually running already, the long trades. And yeah, that's the current returns in terms of based on the entry price. So it's about 2 to 7%. And for Super Micro, currently it's not being triggered yet. Yeah, so that's all from me now. I'll pass on my time to Peggy to give a Phillip on the ground on Yangzijiang. Thanks.
Yeah, okay. So I'm not Peggy, but because she's in the Semcom Industries Investor Day, which is almost like half a day. So let me just run through what she was mentioning. Some of the meetings for Yangzijiang Shipbuilding. This was an update, so there's no financials. But the key message is that the order wins. So firstly, they did secure order wins, but it's a bit slowing down because as you can see, 9 months was almost 6 billion. So right now it's only running at 700 million, which is far below the first half run rate of almost 5 billion. One of the reasons is because it just have too many orders. So if you order now, the yards are full until 2026. So the issue for them is just a lack of capacity. And you know the share price runs on order books. So if they don't take on order books, we think there's going to be an overhang on the share price. The other thing is that they mentioned that the lower container freight rate. So most of the orders that they're getting now, which to the market surprise was mainly from containers. Although, you know, container rates has actually collapsed by almost, I don't know, 80-90%. Mainly because to meet the IMO targets, which is the carbon targets, a lot of them actually is mainly MERS, this ordering methanol type of vessels. And the other thing, one catalyst she mentioned is if they were to secure more land to expand the yard activities, but there's no details of it. She still thinks it's positive because of the regulatory environment that they are pushing more vessels, but it's just that the decline in freight rates, the order book is already filled. They may be a bit more the negatives. There's going to be a lack of momentum on this stock because if they can't take on any more orders, right, since they're full. So that's the key. That's the key message. Probably did it wrongly, but anyway, next slide. The next one is Keppel Infrastructure. So for Keppel Infrastructure, the positive is they mentioned this. They announced a special distribution income of about 2.33 cents. You look at the second bullet point. So that was a surprise. They normally don't do update or that's why they announced it. They had an update to announce this special distribution. So why they had this special distribution is actually nothing to do with the operations. If you look at the third quarter, the the free cash flow to the free cash flow to equity actually down 51%. Mainly because I think they push out the amortization. Basically, in layman terms, you pay the banks later or pay the banks slower. So as a result of that, they actually freed up a lot of cash, and then they're they freed up about 273 million. Then half of it for distribution for acquisition, and another one they use it for special distribution. So I wouldn't call it the most high quality way to pay distribution, but they mentioned that they're going to pay it. So the outlook is that the one other thing I want to mention was that for infrastructure assets or renewable assets, the valuations could be getting hurt because of the high interest costs. And then the lack of credit availability, I think something like office, because if there's no one making any acquisitions, then the valuations will naturally come down because financing is tight. So tight financing affect new projects, and of course it's going to affect the valuations for new projects too. So I guess she's a bit negative on this stock, even though they're going to announce a special distribution. The next slide. SIA Engineering, okay. So for SIA Engineering, the one message is that the revenue rebounded very strongly because you're comparing to COVID. But the surprise was that because most of the earnings, actually, if you look at the table on right, actually comes from associates. But even though earnings jumped 40%, the profit broke even. So I'm not sure how they do their revenue up so much, but then the profit was just broke even. But they said that there's a delay in recognition. But the outlook is still positive because what's happening right now in the engines, which is mainly in the associates line, most of the profit is because Pratt & Whitney mentioned that there's an engine problem now. So of course it's not good that there's an engine problem, but what is happening is that they're going to need more checks for almost 600 to 700 engines until 2026. So Pratt & Whitney has 13 facilities, which obviously we don't care, but there's only one that's in Asia, which is Eagle Services, which is 49% owned, associate owned. So that will benefit SIA engine because of this Pratt & Whitney, the need to do a lot of checks on the engines. Then in terms of the outlook, because of the supply constraint type hangar capacity, it's going to be positive for SIA engine because there's more demand for faster turnaround and so forth. So the outlook for SIA engine in conclusion is actually quite positive. Next slide. So I'll just do a quick one for Civmec. So Civmec, as you know, is an Australian contractor, but they not only just do for houses, like we have our construction companies here, they also do for energy because there's so many mines, there's resources, LNG, infrastructure, marine, and the new one for them is defense. So they're also performing well because the increase in mining activities, especially after the better relations between China and Singapore. I won't run through everything, but the management has been very positive because they see that there's a positive outlook based on the orders that they are when interacting with the customers. The only thing negative is that because construction is weak, then there could be more competition from the normal construction companies. I think that that's more or less it. I think not much, but I think for her the outlook is good. As you can see, the order books are climbing, and they are benefiting from rebound in resource sector and also infrastructure and defense. As geopolitics between Australia and China is, I think they are spending more on defense. I guess. Okay, thanks. Next one. Obviously, I didn't do a really good job on that, but okay. Okay, I'll move on to the results. So for Venture, they announced their third quarter results. The results was weak. So earnings was down 35%, and it's below our expectations because it's like 70% for a full year. The positive is actually net cash actually improved. So now they have about almost 900. Let's make it 1 billion. They have 1 billion of cash. So we think this should enable them to maintain the dividends of 75 cents, which give them at $12 about 6% dividend yield. The negative is really just the top line is bad, margins is also bad. The second point is the revenue slump. So the revenue in the third quarter was actually really poor because the revenue is somewhat similar to during the pandemic, when it was the worst of times, no supply chain constraints. So they're actually trending towards pandemic type revenue, although there's no pandemic. So it's actually quite a very weak set of results. For us, in terms of the outlook, we expect the weakness to persist into the fourth quarter. Sorry, not third quarter, it's a typo here. So we expect the weakness to persist into the fourth quarter. what they did say was that they think new product introductions. So new product introductions means customer introducing new products, and it usually benefits venture because when new products, margins are better and you can raise volumes. And also they said that customers are shifting from Southeast Asia, but they weren't willing to commit to a stronger fourth quarter. So what we think is that although customer give them new projects, that means you got new products to manufacture, but the volume ramp by the customers is unclear. So for us, we cut our profit by 8%, and we also lowered our target price because they used to trade about 15 times PE, now going to 13 times because the growth they've gone S growth, so there's a bit of X growth, so there's a bit of derating. So that's why we also cut our target from 15 times to 13 times. So we maintain our neutral. Next slide. So I'll run through just the usual macro. So in general, in the Singapore economy, things are just trending along, and then just moving sideways because manufacturing new orders is moving sideways. So new orders is important because it's a bit of a forward visibility, because they will ask the purchasing manager in Singapore, how are your new orders? So it's more or less still contracting, but I guess it's not really worsening. Retail sales in Singapore also just moving sideways. It isn't particularly strong. August is 1.5, sorry, it's not 5%. But the improvement is actually in supermarket, but from 1.3 to 1.5. The good news is actually in export. So Korean exports actually bumped up from their first gain after 13 months, but I guess it's only natural. After 12 months of contraction, the base effect is there. For US, the new orders was actually particularly poor because it's a sharp decline in manufacturing outlook. It was like 49, then October dropped quite significantly, 45. We also got payrolls numbers, also another weak number. So far moving into October, most of the data coming out from US is weak. Their payroll additions, that means new hirings is 150,000, below estimate. But when we do the numbers, we are a bit more worrying is that almost 90% of it is from government, healthcare, and social assistance. So these are the non-economic sensitive. The only sector that's only employing is the leisure. So other things declining is financial, transport, and technology. Not UT, is IT. Yeah. Next slide. So in terms of our tactical views, I think what we see right now is interest rates really gap down quite significantly. This is going to be positive for REITs, I guess, because what happened is that the effort, like what Sean mentioned, Jerome Powell basically didn't comment anything on December. Although just 1 month away, if you compare to the prior meeting, he mentioned there's going to be chance of tightening. So this time around, there wasn't any such thing. And then together with the weaker payrolls that I just mentioned, there was a big drop in the US treasuries, in the US bond yields, almost 40 basis points in, I think, over 3 days. But we think we are still a bit more worried in the very near term whether bond yields can actually drop, because the treasury. So there's one data point which actually nobody pays attention to, but every quarter the treasuries, basically the US government will tell how much bonds we need. So they are saying that they need another 1.6 trillion for the next 6 months. So this is a lot. Although in the coming quarter it's about 700 billion, which is less than the fourth quarter is 7 billion, less than September 1 trillion. But what is trending now is that the US is now looking to raise bonds of almost 3.2 trillion per year, compared to 1.5 trillion. So the amount of bonds they need is almost more than double. So even though rates are coming down, we're not sure how much more it can come down, especially if the US government is going to continue to raise of almost 3 trillion of bonds every year. Yeah, I will show you a chart later to explain. So for us, we think next year interest rates can still come down, because we think if there's a slowdown recession, the Fed will cut. But I think interest rates is still going to be elevated in the long term, because we think this deficit spending by the US means that there's going to be a lot of supply of treasury bonds, and when there's a slowdown, it means that the government's going to spend more and going to buy more, going to issue more bonds. Yeah, they actually shouldn't be doing this because now the economy is strong. But when the economy weakens, the deficit widens, means they need even more bonds to come out. So we're just not sure how bonds are going to come down if bond yields are going to come down if they're going to issue more. Another point that we made in our usual weekly strategy was that among all the companies we met, the operating environment is still very slow. We don't really see many corporates saying the environment is really strong. one comment we get is that the strong US dollar is also pressuring emerging markets. So you're talking about Indonesia and so forth. The strong US dollar is going to hurt consumer spending because it will make commodity prices higher and inflation. Okay, on a very upbeat note, anyway, the events coming up, we have DBS results today. Glenn is in the meeting, so I'm not sure he can join us, but we have SIA, then we have Singtel, and then OCBC on Friday. We also have a few webinars. Some of the new ones include NEO on 18 and CSE on 22nd. If you do have time, this is open to anyone, so if you have time, don't feel free to register. Next slide. Okay, so anyway, this chart, if you look at the refinancing needs, so this is the amount of bonds that the US government needs on an annual basis. So you can see this big spike. In first quarter, they need almost 3.2 trillion. Compared to pre-pandemic, it was only 1.2, so it's almost more than 1.5 times. And one of the reasons why the government bond needs so much, you notice this big jump here in 2020. So of course, you will say that, oh, it's not as much as fourth quarter, but most of these bonds are not long-term. So what it means is that in the coming years, this blue line is going to continue to rise because I'm not sure how much of this 4 trillion that they borrowed during the pandemic is really 10-year bond use. I think most of them could be very short-dated bonds. So as a result of this, in the coming years, the Treasury is going to refinance and need even more bonds. So that's why this will keep interest rates elevated, even though inflation might be coming down. That's what our worry is. Next slide. So this one just labor conditions. The number there is just to show you why after 150,000 new jobs, 51% comes from healthcare and social. So I'm not sure how much is this really economic sensitive compared to maybe 27% in the 2017-2019 levels. So this is just for reference. Next slide. Okay, so we'll go through our usual model portfolio. We were down 4.3 in a month, just for reference. Most of it was down to small cap like Propnex, ThaiBev. Everything went down, yeah, except ComfortDelGro finally for what. But the market, the Singapore market was down was down 4.7. So although we did better, but not much of a consolation. But you'll notice that the whole market for Singapore 2023 up to October is down 5.6. So most of the sell down for Singapore came in this month alone. Next slide. So just for reference, in terms of sectors that did well, what didn't do well is of course shipping because of Yangzijiang and Citrum. And then conglomerate was weak because the whole Jardine group. So if you look at the top 10 SPDR or STI ETF, the losers, Jardine group was really hurt very badly. You can see that the dairy farm was down 20%. Jardine was also down almost 13%. Jardine CNC was also down about 12%, and then Citrum down 16%. So these were the worst sectors. There was only one stock in the whole STI, I guess, that was up, and that is Genting Singapore. Emperador was flat, so I guess it's the outperformer. And the top is just some of the stocks that we just look at. Not look at, I mean, they just monitor. There's a bit of volume and coverage. Like IFAS, Aztec, these were the big gainers for October. Again, all this is just for your reference. Next slide. This is just by asset class. So it was another weak month for interest rate sensitive. So if you look at the REITs, so this is in US dollar terms. So REITs was down about 7%. Gold did well, and of course US was also down, and bonds also down. So REITs look interesting. I mean, after the last 2 months, I think they're down almost 14-15%. Next slide, in US dollar terms. So sorry, I just got 2 more last time. I know it's very long, but just to share some highlights from the Wilmar briefing. So Wilmar's, just for those who may not know, so Wilmar's main profit comes from oil palm refining, oil palm plantation. So that's one part. Then they got soybean crushing. So basically, they'll buy soybeans from the US, crush it, and the meal they will supply to the hog farmers. And of course, they also, in China, they're very big in edible oil, but branded edible oil in China. So the earnings was bad. I mean, it's down 59%, mainly because last year was exceptionally good because palm oil price was high, and then their refining margins was very strong in Indonesia. So I won't run through everything, but the key point is that in China, they think the worst is over, but they do not see any improvements soon. And then anything on El Nino, they said that because the big hope for palm oil was that there'll be El Nino. So when El Nino conditions are dry, then production for palm oil usually drops probably a year or two later. But what they said was that it's dry, but it's better than expected, and it's really raining in North Malaysia and Medan and so forth. So for us, we think for Wilmar, is any recovery is going to be very gradual because China is they need China to grow stronger because most of the operations are there. So, but they just say that China bottom, but it'll be very gradual in recovery. So don't expect anything exciting for Wilmar, I guess, in the near term. Next slide. Then one last one for me for Singpost. Singpost is a bit better. So Singpost, of course, we all know who Singpost is, but most of the profit, just for those who may not know, they make profit from posts, of course, not until recently, and also parcel. Not only do they deliver letters, but they also deliver parcel. The one unique thing they do is international parcels, which I think we described before. So because Singapore is a hub, so someone from China want to send a parcel to Europe, they can actually send it to Singapore. Then in Singapore, they will aggregate all the volumes and ship it to Europe for parcels. The area that Singpost is pushing hard, and they just made a 200 over million acquisition is logistics in Australia. But right now, actually, most of the profit actually come from property rental. I don't have the number here, but they make actually 20 million profit from Singpost, from rental income. So you could say maybe three-quarters of the profit now comes from property rental. The earnings was weak because the post and parcel. I won't run through too much in view of time, but we think the outlook should improve because earnings should recover. Because if you look at the third bullet point, because of the higher postage rate, they mentioned that it could turn profitable. So we think earnings can recover. Also recovery international parcel, and also the completion of the strategic review, which in our opinion can only be better. So for those who may not know, the authorities have mentioned they will do a review of the whole Singpost parcel postal system here to make it more profitable for them because they're losing money. So one way they could do is, I'm not sure what way, but one way they could do is maybe like a net link model where Singpost can charge a certain amount to the customers, a fixed amount that they can generate higher returns, basically higher postage rates in a nutshell. They can also do like a ComfortDelGro bus model whereby the government take over all the fixed assets, and then you just earn a fee, a charge rate, a fee for running the service. I'm not sure what model they're going to use, but it could be either of these or even more. Okay, I think that's it. Sorry I think today's a bit long, so thanks everyone. Just we normally do our webinars on Monday, but there's Deepavali, so happy Deepavali. But there'll be no webinar from us. Thanks everyone. Okay, move on to Q&A. Yeah.
Thank you, Paul. So we'll take on a few questions on PayPal. So first of all, assuming at PayPal, if there is a recession in US in 2024, would you still recommend it as a buy? So we believe that if there is a recession, it might impact the consumer spending and it might impact PayPal's growth. But we believe that the risks has already been priced in, and the shift to electronic payments and e-commerce secular trends, they are still here. And in terms of PayPal, it's working hard to maintain its stickiness from its users to its platform, mainly because it's continuously adding in new features. Like recently, it has announced passkeys for its frictionless payments, which should enable smooth check-in sign-in process. And also, it has announced like cryptocurrency buying and trading on its platform, as well as tap to pay on iPhone. So additionally, we also believe that it could tap the generative AI market by it has a strong user base of about 428 million active accounts. So and of that, about 400 million are towards users and about 28 million towards merchants. So what PayPal can do is, since it has the history of customer data, it can work with merchants and it can give personalized offers to users, and then it could help to increase their payment volumes on its platforms. So we believe that long-term catalysts are still, opportunities are still there for PayPal. And moving on to the second question, your target price is double of its last trading price, a buy not accumulate call. when your target price is almost double, plus your call is for duration of 12 months. So our target price on PayPal of $101 is over for a period of 1 year. And we believe that the downtrend it significantly happened after the second quarter results, and this was mainly because the market they had concerns like its gross margin had been mainly contracting because of the business mix shift towards its Braintree unit, which is low margin business. However, in this quarter, PayPal it had announced that its payment volume towards its core PayPal checkout button it should increase going forward, and it should help to increase its profitability. And also it expects e-commerce trends to increase by double digits over in FY24. And lastly, for PayPal, we believe that it's a value play mainly because it's currently trading at a PE ratio, forward PE ratio of about 10 times as compared to the industry average of about 20 times for Visa and MasterCard. So that's all for me. I would now like to pass on to the rest of my team.
Thanks, Ambrish. I've got a couple questions here on AMD and Apple. So the first one is, what's your thoughts on Apple's Scary Fast? So Scary Fast is just an event that Apple had to kind of promote their new products. So their new Mac product and their new M3 in-house built chips. In terms of what I think about it, I think it's not. I mean, it's just like showcasing what they've had so far. A little bit of backstory is that they are actually in-house producing a lot of their chips now, and it's a trend that a lot of OEMs are actually moving towards. On the call, actually, Apple mentioned the biggest reasons for them moving in-house. Although it does kind of affect their margins a little bit, it has provided a lot of flexibility in terms of innovating new products, and at the same time, they also have more control on the supply chain, which maybe like 10-15 years ago was a lot more certain than where it is right now. So yeah, so that's kind of essentially what they were promoting. Nothing out of the ordinary, and but it also comes as demand for a lot of these products is still relatively weak. So we don't think it will really help to boost anything in terms of revenue or earnings. It's just just a promotion for some of these products. The second question is AMD 2 billion sale of AI chips a bit too ambitious? NVIDIA is much better. Yeah, so actually, when you think about it from a fundamental standpoint, it's a relatively new business. So as a new business starts to scale from essentially zero, the first part of ramping, because there's a lot of backlog in terms of demand, you would see growth rates that would be rather exponential. The company already guided for 400 million of these of revenue for these kind of AI MI 300 chips in the fourth quarter, and even for the first half of next year, 400 each for the first 2 quarters. It also mentioned that the second half would be roughly a 50% increase compared to the first half. So if you just calculate 850%, that's 1.2 billion. So it's around about 2 billion for the year. I don't think it's that out of the ordinary or too ambitious, because a lot of these orders, AMD would probably have quite a bit of visibility on the orders because they come from enterprise clients who would have already expressed interest and will have already at least put down some sort of commitment for to order X number of chips. So they probably have some sort of visibility. And like I said, when you compare it to NVIDIA, it's still a very small piece of the pie. So yeah, so like I mentioned earlier, so the chips are not as good as NVIDIA's GPU chips, but I guess they're not meant to be as good because they're not as expensive either. So it's more like providing an opportunity for people who maybe cannot afford the best, but still want to get into the AI trend. It gives them sort of a cheaper entryway into this kind of space. Yeah, so hope that answers your questions. I'll hand it back to the rest of my colleagues. I don't think I have any more questions yet. Thank you.
Yeah, I'll take a couple. Manulife lenders, are they mainly US regional banks? No, actually, Manulife lenders, most of it are local banks. Most of their lenders are local banks. Yeah. Any outlook for the hospitality stocks such as that is HMM is CapitaLand Ascott Trust and J85 is CDL Hospitality Trust. Yeah, so these two stocks, they continue to benefit from the recovery of travel, and we are of a house view that the hospitality sector will be the only subsector for REITs to be able to generate DPU growth going to next year. So we are still positive on that, as like the increase in RevPAR across the board will help to increase the revenue as well, especially as some of the master leases, for example, start to get a variable rent contribution. Yeah, so going forward into next year and into end of 2024, we are still quite positive on the hospitality REITs, as we believe they can grow their DPU. And then the other two stocks there, C6L and S58, that is SIA and SETS. I think Peggy covers them, but Peggy's not here. Maybe Paul could cover, so I'll just leave it there.
Yeah. Oh, okay. Just one quick thanks. I don't really. I think for sets we are probably a bit more neutral, but for the local hospitality, there's very clear visibility as we enter into first half 24. I'm talking mainly for the Singapore ones, because in the first half of next year, there's a lot of events. We have Coldplay in January, then we have Air Show, which is every 2 years event in February. Then of course we have Taylor Swift in March, and then we also have Rotary International in April. Yeah, I do not know how big is Rotary International, but that's what the hotels are saying. So we have very good visibility of very strong first half for Singapore hospitality. But international is a bit harder, but at least there is that visibility. So for local hospitality stocks, we think the momentum can definitely carry until first half, because there's a lot of events coming up. So even like Genting, all the Frasers and hospitality and so forth. For sets, I think Peggy is not here. She's in the Semcon Industries Investor Day. I think sets she's a bit more neutral because of the recent acquisition, and number one, and because the recent acquisition raised their gearing, and then they don't think that because that company that they acquired is very strong in cargo, and cargo is actually coming off very strongly compared to pandemic times. So and also number two, sets took up a lot of labor cost upfront in preparation for that. So I think sets we are a bit more neutral for sets. And then SIA, I think she has a reduce, mainly because the competition is coming up, not to mention oil prices. So for us, we just more worried about competition. So the better way to play, I think, is probably SIA Engineering. That's my own view, because you have this added growth driver, which isn't a really good reason, but there's added growth driver of engine issues. Of course, it's not the very good thing to say, but that's one of the growth drivers for them. At least there's visibility, and so with SIA, you worry about just the competition and so forth. Yeah. Okay, I hand it back to Miao, I think. Yeah. Thanks.
Yeah, I'll take the Paragon question. Paragon perps, what is the interest rate now, and what will it be when it resets next year? Are they trying to refinance with bank borrowings? Also, they have 300 million perpetuals call next year. Current cost is 4.1%. So assuming the current interest rate remain unchanged, the coupon after resetting will be around 6%. And given they have a very low gearing of 30%, they could refinance through a normal bank loan, which is cheaper than perps. Yeah, so total there will be 520 million loan due next year to be refinanced, and the management is working on it with the banks. And if they are going to refinance all the perps with the normal loan, the gearing will be 37% after that. Yeah. Next one, Paragon REIT. Why would reversion at Clementi Mall and Real Mall fall? Is it consistent with the overall trend of SG suburban retail sector? Yeah, so rental reversion for the suburban for Paragon REIT, a large portion of the lease is actually signed during the pandemic for the Paragon Mall. Yeah, so there's a relatively low base. Yeah, so the reversion should be higher this year. And for the suburban mall, they are already they were already doing well during the pandemic period. And the demand there is very much stable. And hardly they can enjoy any upside from the return of tourism. Yeah, so given the relatively higher base and lack of catalysts, we expect the rental reversion to be flattish. And generally, the reversion for the central mall is higher than the suburban mall. Like for OUE, was around like 20% rental reversion in third quarter, and Suntec was around like 17%. Yeah, and both of them are guiding double-digit rental reversion in FY24. Yeah, so generally for the urban mall is higher. Hope it answers your question. And next one is, with RBA hiking interest rate tomorrow to 4.35%, how will this affect Paragon REIT and IMS APAC REIT moving forward, since both of the REITs have Australian asset? So for IMS APAC, I think the effect is marginal. Although like a large majority of the loan is in AUD, but 77 of the loan is fixed. Yeah, it's a fixed rate, and there's no refinancing needs till FY25. Yeah, so the effect of the interest rate hike in Australia is marginal. For Paragon, they didn't disclose like the breakdown by currency of their debt, but I remember they share like all the loan was taken under Paragon Mall. So I assume like all the loan is in SGD term. Yeah, so the hike, also the effect wouldn't be much on Paragon Mall. Yeah, hope it answers your question. I'll hand over back to the rest of my colleagues. Thank you.
Yeah, let me take the Prime question. Hi, Darren, what's your latest view on Prime? Understand from your past presentation that it is in a better shape financially than Must. Oh, wait, sorry, the question ran. But its share price seems to be heading in the same direction as Must. Yeah, so first of all, because all the US listed REITs, they are very similar to each other, or rather they are the three US listed REITs. So it's when one has some financial struggles, right, it's hard to see the other two share price move in the inverse directions. So yeah, most of the time is they trade relatively similarly, because overall, after all, they are still trading their assets and their fundamental business still in the US, so should have similar business momentum and sentiment. So yeah, it's hard to see them like Manulife go down and Prime or Core share price go up. So yeah, most of the time they trade relatively in line, I would say. Yeah, so yeah, then based on past presentation, is it better shape financially? Yeah, so for Prime, they're releasing the results tomorrow, after hours actually. So we are keeping an eye on them, but we are keeping more of a lookout on the valuations, because like I mentioned in the slide just now, Manulife, they did a mid-year valuation, but Prime and Core, they did not. So it's highly likely that Prime and Core will see a bigger kind of valuation decline, because they did not do a mid-year valuation as compared to Manulife. So Manulife, they've already taken into account since last year over 25% devaluation already. So yeah, that's one thing we're looking at. And for Prime, we are also looking at because they refinanced their loans, they extended it for 1 year, and the maturity of the loans will be about 65% of the loans will be in July 2024. So we are also on lookout on that to see like whether they will be able to refinance their loans at good rates and ASAP. Yeah, so those are the two key issues for Prime now. If interest rates are expected to stay elevated in the long term, what's the long-term impact on the REITs? Yeah, so if interest rates, of course, stay longer, then the REITs will have to pay higher interest expense or finance expense for longer as well. So that will affect their DPU that they can pay out. But the silver lining is that there are a lot of it, the REITs over the past few weeks, as Paul had mentioned just now in the slide, that the REITs, the share price really corrected quite a bit. So there's a lot of the impact of this high interest rate, we believe that has already been priced into the market and is looking quite attractive, like from maybe a price to NAV point of view, as well as a forward dividend yield because of the share price correction. So yeah, in the long term, based on current share price, we think we are still overweight on REITs for now. But we do know that in a higher or for longer interest rate environment, the REITs will still be quite challenging for them to grow their DPU, as a huge chunk of it will be used to pay off the higher loans, higher finance costs. Yeah, then there's a follow-up. What's the impact of global economy, and is it always negative? Yeah, I'll leave the macros to Paul. For Manulife, do you have a sense how fast they can reach an agreement with the banks? It has taken quite some time. Yeah, so it's taken almost half a year, I believe, and we are hoping to see some good news by this year, but there are no fixed date as to when they can reach an agreement. So, but they are advancing quite fast ever since their sponsor has put Mr. Mark Feliciano, the head of global real estate, into the to chair the board. So he's the one leading a lot of the talks with the lenders. So after they did that, then negotiations have been progressing quite fast. But it's been taking so long as well because the whole sponsor package is based on the whole loan expiry as well. It's not just the next couple of years. Yeah, so that's why it's also taking so long. And yeah, there's one more on outlook for Keppel DC if recession happens. Yeah, so if a recession happens, the whole economy will not be very good shape, definitely, and then a lot of the REITs as well. But for Keppel DC specifically, they have 27.7% of the leases expiring in 2024. So if a recession happens, so this chunk of leases renewal might be challenging and face some headwinds, as well as their current tenants. Yeah, if a recession happens, their current tenants might not be able to, might not be so easy for them to pay off their rental income as well. So these are some of the headwinds, as well as, it might be it's a similar headwinds to other REITs as well. Like if a recession happens, the tenants might not be able to pay rents and such. Yeah, so it's not just a Keppel DC specific thing. Yeah, I think that's all for me. I'll hand over to my colleagues. Thanks.
Yeah, before I pass it on to Sean, so for Manulife, REIT, the US REIT, they need to negotiate with the banks. It's not only just 1 year. They need to refinance their whole the whole slope of the whole maturities that's coming up the next few years. So what we think might happen is that, of course, the banks will want you to top up and add in some equity. So we think they can add in the equity with the 100 million cash. And then the second thing is they will sell FIPS to the sponsor. So both of these could generate almost 300-400 million for them. The unknown is so there could be three things. There will be a lower repayment of debt with the cash they have. The part two would be FIPS sale that probably could generate 200 million cash. And then the third thing is the EFR. So the EFR, we're not sure how dilutive it is. That's the bit of the unknown, because the banks will also say that your valuations will probably drop down one more time. So the banks will basically need a lot more equity to protect themselves. But we think that the sponsor could backstop. But this is our own speculation, that if there is an equity fundraise, because they will not know who is going to take up, so you're not sure how much you can raise. And the banks will want some surety. So what we think is that the sponsors could come in and provide an unsecured loan to fill up any gap, because the sponsor can only own up to 10%. If they could probably want to take more, but they cannot because of the REIT structure. The maximum they can take 10%. So we think by year end they probably announce something like that. But just a bit of warning, the conditions are still very tough. Like what Darren said, the operating conditions in the office is still very tough. So you should expect another round of devaluation by the end of December for all the US REITs. But of course, Manulife will be much less because they did it mid-year. So that's something to just take note of. But Manulife can really, because it's not, even if operating conditions are big, because it's just to renegotiate the whole structure, and it's more about them staying around rather than the whole the whole US operating office conditions are improving. I don't think it is. I think based on the meeting that they had, I think the operating conditions is still quite tough for office. I'll hand it to you, Ashan.
Yeah, thanks, Paul. So on the question on with Fed interest rate likely to have peaked, does that mean that our SG T-bills or SG savings bonds with their interest rates offer are likely to continue to decline? So I know it might not be too pleasing to hear, but the short answer is yes. Because as Corp has mentioned earlier, there was a 40 basis point gap down on the US 10-year Treasury after the meeting. And also, our government bonds also do have some correlations with the US Treasuries. So just to recap, our SSB tracks on the average yield of our SGS bonds. So similarly to the US 10-year Treasuries, which have declined after the meeting, our 10-year SGS bonds yields have also fallen off slightly and is currently trading around 3.21% as compared to around 3.38 to 3.39 range before the meeting. So, I mean, yeah, we should expect a slightly lower yield offering for the upcoming windows, unless there are events which cause a spike in interest rates once again. However, I mean, the decline for the upcoming windows should not be a drastic one, as rates are still expected to hover for a little while longer. So before it tapers off in the later half of next year. So, I mean, for fixed income investors, if they're still interested in locking in the rates, this might be a good opportunity at the last few leaks, I would say, to capture the yields before it tapers off next year onwards. Yeah, hope that answers your question. Thank you.
Yeah, thanks. So I'll quickly, just as much as I can, run through some of the questions, and I hand it over to Sean. So sorry to delay this. So I'll hand it over to Zain. So on Grand Banks, frankly, I haven't met up with them recently, but I think what has happened is that because of the pandemic, it introduced this type of because Grand Banks builds yachts, but it's not the ultra luxury. But I think because of the pandemic, it introduced I guess this yachting activity to the masses, because everyone was stuck, cannot travel. But the issue, or at least for me, I do not know, I never met them recently, is whether is this just a pandemic-related bump in spending, and whether can it continue for the next few years. So I'm not sure that one. Is this like a 5-year cycle where everybody decided they want to go yachting, or they're taking more share? I'm not sure. So the other question is, Grand Banks reported good results, but no effect on share price. Can we invite them to lunch? Yeah, I will try my best to invite them. Sometimes it's not about us inviting them. It's just whether they want to attend. But I'll try. I think no harm. Yeah, thanks for that. Paul and team, your view on an outlook for Thai Bev. So we still like Thai Bev. I think because one of the Sabeco Saigon beer announced big results. I think their earnings are down 30%. So that's why it also hit Thai Bev. But do know that Saigon's contribution to Thai Bev's profit is, I don't know, maybe 10%. It's still very small compared to their spirits business. So that's why it doesn't derail us from our buy recommendation, especially when we know that 2024, the Thai government is going to do this massive fiscal spending, so which will boost consumer spending in Thai Bev. And secondly, the valuations are trading at pandemic lows, so that's why we still have a buy on Thai Bev, and it's in our model portfolio. Okay, is venture or Valuetronics a better buy? So we prefer Valuetronics. I thought he has a buy call. Like we highlighted before, I think the downside is protected for Valuetronics because they got number one, there's a share buyback program. There's another 60 million worth of shares to be bought. Maybe now 58, 59, but you can see the volumes there's hardly even 1 million shares. So there's a lot of, just that you don't see buying now, because when the results are coming out next this week, then because of that, they cannot do buyback. So that's why the share price might be weak before the announcements. But I mean, like I said, there's a $60 million shares out there. There's a buyer for 60 million, just that he's not an aggressive buyer, but he'll do the protection 3/4 of the share price is in cash or more. And they announced 4 new customers, which is very rare. They usually don't explicitly mention they got customers, but mainly because they had a new factory in Vietnam, and then they're getting customers out of China. So that's why we think value is a better. Will the US government shut down again? I really don't know, but the next one is on the 15th of November, I think. And even if there's a shutdown, the last time there was a shutdown for 34 days, the impact to the GDP, to the US economy was, I think, less than, I don't know, a 0.01% impact. Because the shutdown only affects 25% of the government spending, but it doesn't mean they will shut down everything, or they will just shut down certain, maybe the parks are closed and so forth. So the impact to the government, to the GDP isn't much, but of course sentiment and all that will be very bad. Yeah. But the impact to the economy is actually very meager, even if it's a 1-month shutdown. Okay, let me just take this. Treasury financing needs and rates still high, then market will be under pressure. Yeah. So what we guess, and it's more like guess, what we think rates will still come down because we think US growth was slow. But what we're just trying to say is that because the Treasury needs to do a lot of funding, it doesn't mean it will gap down like the 2% that we saw, or 3%. We probably, base case, we're probably looking at maybe the mid 3s to maybe high to the 4s, to the low 4% in terms of 10-year Treasury bonds, because of the amount of issuance needed. So that's what that's the message we're just trying to say. I don't expect interest rates to really collapse when the government needs so much to borrow so much. Yeah. That's the main message. Who's buying more treasuries? Not since that. You're right. I think but because the US dollar has been strong, so you can't say the Chinese or Japanese are not buying. I think they have to rely more on the domestic buyers, and you might see the movement. I mean, the liquidity might flow out of equities into bonds, because after 10 years, this is the first time you're getting proper interest rates as a bondholder. So the hope is that to fund that will be the liquidity coming out of equity. I mean, among the domestic buyers, because you never had 5% interest rate on a 10-year bond for I don't know how many years. I think maybe 15 or 20 years. I'm not sure. Yeah, I forgot the number. Yeah. Okay. Okay. On venture seem to recovering slower than some of his peers like UMS. What do you see? Okay. I think although venture is very tightly about customers, I think when ICOS second or third source, I think that probably hurt venture a lot, because venture, I think, was the main supplier to ICOS, the Phillip, the e-cigarette. I think that one gave them the big boost in earnings 2018, 2019. But then when they started to second or third source, then I think the volumes dropped, and that impacted venture, my own guess. And then UMS Franklin, because semiconductor equipment spending doubled or tripled during the pandemic, and then they started to source more out from Asia. So that's the difference. It's the type of customers they had. Venture actually does do for semiconductor, but of course it's not so concentrated. Like UMS, almost everything comes from one particular customer. Okay, I hope that answers some. And then I hand it over to you, Zin, to the technicals. Yeah.
Wait, Paul, maybe I'll just do this bank question first.
Yeah, thanks.
Yeah. Okay, so there's this one question: for the 3 local banks, what is your view on its share price impact due to changes in Singapore interest rates? Is it symmetric? So I think the example you gave is Singapore interest rate rises, and also if interest rate falls. Yeah, I would wish that would be true, if it's really symmetric. So let's say the interest rates go up, means the share prices all start to go up. I don't think it really follows that per se, because if you look at the historic like how the share price has been moving, especially in the last year or two, it doesn't really follow the interest rates. So there's a lot of factors to what impacts the bank's performance as well as their share price. And I think interest rate is just one of that. So if you look at the interest rates, if it goes up, it looks like a good thing for the banks, but it's a double-edged sword for them, as I keep mentioning. The first thing is that, of course, the positive would be, they are able to benefit from higher net interest margins, as they can charge their customers higher, so they can earn that larger spread, which increases their net interest margins. But of course, on a negative, it will lower their loans growth, and we have been seeing that happening with this continued high interest rate environment. So their loans growth is now I think it's all negative, and they're looking at even like maybe stable loans growth or flat, at least flat. So very low loans growth. But then again, they sort of offset that with the increase in their net interest margins, and then they're all like showing and performing quite well with very high net interest income as well as earnings. So I think and I don't think the interest rates it's really very indicative of how well the bank will do. But definitely, from what we are seeing now, the higher interest rates are more than offsetting the lower loans growth. Yeah. So if the interest rates falls, we will have to we can only predict the banks are all saying that no, it won't really affect them as much because they managed to lower to sort of cap their funding costs. So we should wait and see what happens. Yeah. Hope that answers your questions. Thanks. So I'll hand it over to Zane for the rest, for the TA. Thanks.
Thanks, Glenn. Okay, I'll start sharing my screen for the TA. Okay, yeah, so first up will be CapitaLand investment. So currently, there's been a rebound, and good positive is that we actually managed to break above the $3 mark over here, which was a spot that actually there was a breakdown from. Currently, I think there could be some form of resistance coming from this downtrend channel resistance over here again. So and probably there will be some pullback and see whether this $3 mark is able to hold. Then if it does, then that could be a positive for potential more upside. If not, then we are likely to revert back into the main downtrend itself. Okay, the next one will be MPEG. So for this counter, I think it's continue to trend outside of this downtrend channel over here. But actually price there's some pickup in terms of momentum wise recently, where price made a lower low. And currently is rebounding into an area of resistance close to the 148 level. So I'm expecting some resistance at that level. Yeah. And let's see whether the price actually just consolidates afterwards. Okay, then next one will be 9866 Xpeng. Okay, for Xpeng, looks like there's a breakout of this descending broadening wedge pattern over here. So that is typically possibly bullish. Then we also have recently had a crossover in terms of XC. So currently, I think there's still possibly some resistance from this swing high at which is around $68. Yeah, sorry, $71 to $72. So if you're able to backtest this breakout and its holds, and that will be I think there will potentially more upside could come to try and retest the next resistance around the $76 mark. Okay, then next up will be STI. Okay, STI currently I think it's likely entering to an area of resistance. So there's a confluence of resistance around the 33170 level. So this look at the blue lines in focus will be this will be a retest of this neckline breakdown over here, as well as this downtrend resistance line. So I'm expecting some resistance to come in for STI this week at this level, and potentially a pullback to come. Okay, then moving on to the three local banks. The first one will be DBS. Okay, so DBS has just formed a range recently, and looks like it's currently retesting this uptrend channel that it broke down over here. So currently there might be some resistance coming in around the $33.50 level. Yeah, and probably it might just consolidate a bit for a while for this. Okay, then moving on to UOB, as a rebound, but it's also at an area of resistance currently. So this zone which is around $27.80 to about $28 was this prior support area that price broke down. So currently it's doing a retest. So I will expect some resistance, short-term resistance over here. Possibly price to just sideways or a bit for a while. And next one will be OCBC. And OCBC also retested the swing highs around $13.10 over here. So could be some consolidation first before the next move. Yeah. Then moving on to some of the counters, starting off with UMS. UMS, I think currently is probably in a range formation over here. We just need a retest of the 134 swing high levels. But I think we could just see some sideways for now, given the lack of momentum in terms of the indicators. Yeah, where it has been forming lower highs and lower lows. For Franken, Franken is similar as well. Currently, it's also very range price and rebounded from support 104. And currently, there's some resistance at 113 this level. So there could be some pullback or consolidation take place. And the next resistance again will be around 119 over here. Okay, then next up for AEM. AEM looks like it's still kept in this bearish flag pattern, pattern over here. Since the breakdown of this uptrend channel. So yeah, I think looks like just still sideways for now. You can see from over here where it's 340 to about 360 over here. Then as for iFast, iFast has seen a breakout over here recently, but the volume has tapered down and the candles are getting better. So currently looks like it's just consolidating after such a strong move for now. Yeah, then there's also some resistance at 690. Yeah, 690 was a prior swing high to February 2021. The next resistance level upwards will probably be around 715 as well as 750. Okay, the next one is Parkway Life REIT. Okay, Parkway Life also currently doing a retesting, which was this support range that it broke down from 355 to about 360. So the confluence of this downtrend resistance line over here, I'm expecting resistance to come in over here for now in the near term, and positive price might pull back a bit since we are trading in a downtrend stretch over here. Okay, then some US counters will be Broadcom. Okay, Broadcom, a positive will be that in this pullback, price has formed a higher low over here, and then looks like this stretch of pullback has ended with this higher high taken, higher high being formed as well. So currently there could be some resistance around 880 to about 895 for now, but I think might lose a bit of a consolidation first, then maybe price could continue to hit higher towards the strong resistance at around 915. Next one, it will be Amazon. Okay, Amazon for now looks good since there was a last week there was a break up, managed to break above this 133, 134 resistance level over here. So price has headed higher. I think next resistance probably will be around 140, 141 this level, followed by 143, 144. So I think price could hit higher, but since could be near some resistance levels where there could be some consolidation after a strong move last week. Okay, next one will be Google. Okay, for Google, looks I think it's good. 127, it did a retest of the breakdown, and looks like price is managed to hold this level with an engulfing candle on Friday. So with that, if it continues the momentum, we could go and see Google retest some resistance level upwards of 131 to about 134 in the near term to maybe fill up this price gap over here. Okay, for ComfortDelGro, I think for now it's still trading in an uptrend channel over here. Yeah, so I think nothing too much for now. Not much volatility. Yeah, so potentially we could see a retest of the highs at maybe 136 if it continues its uptrend. And for Singtel, Singtel also yeah, at some resistance levels, 247 to about 250. Yeah, then I think once it hits this zone, maybe we could see some consolidation. Then for SIA Engineering, The SIA Engineering, I think it's still trading in this uptrend channel over here. So a rebound from the main trend support. Also managed to break above this 380 level, this 380 level. So I think for now, could head higher if it continues the bullish momentum. We try and retest the highs around close to $4 over here. Okay, then for SIA Engineering, also after the earnings release, there was it retested this 240 strong resistance level, and came down a bit. So I'm expecting price to sideways a little bit, but to hold the support around 233, 234 this level. Yeah, so I will expect some sideways movement for a while first for SIA Engineering, given the strong resistance over here. Okay, then for Genting Sing, I think looks like a possible reversal after a period of downtrend. Just looks like a double bottom, then price hit the 85.5 cents breakout level with a retest last week. Currently it's testing the resistance at 89 cents to 90 cents over here. So there's also a downtrend resistance line acting over here. So maybe we could see price sideways a little bit at this resistance zone over here. But the good thing is that it's starting to form higher lows and higher highs. So I think probably the stretch of downtrend over here is probably over. Okay, then for Mapletree Logistics Trust, I think it's currently doing a rebound, but I think most likely it's probably to do a retest of this wedge breakdown over here. So yeah, quite near some resistance at around 158 to about 160. So I'm expecting some resistance at this zone, maybe where price will do a bit of a sideways movement. Okay. In the next question, okay, there's a question on Alibaba. What's your view? Okay, I'll just give my TA view. So Alibaba, I think looks not bad. There's a breakout of this descending wedge formation over here, and then price has managed to recover back above $83. This horizontal breakdown area over here. Because upon the recovery, the price is over here and made a higher high here recently. So potentially you could see price try to hit higher to test $88 this next resistance level over here. Okay, then next one, TSMC. Okay, TSMC also, I think, looking good, because it managed to, looks like a double bottom over here at around $85, and price managed to break back above $89, this breakdown level. So if this holds, I think price could hit higher towards a retest of the recent highs at $93 to $94 over here. Okay, then I think the last TA question will probably be on Tesla. Okay, Tesla currently is I think short-term wise is showing some momentum since there's a breakout of this downtrend resistance line, and it's managed to claim back this 213 level. But I will expect some resistance still around 230 if it does go and touch approach it 230 to 235. Yeah, but yeah, I think maybe just go a bit higher, then we see some consolidation take place. The key will be to see whether there's a higher low being formed for the stretch of downtrend here to be over. Yeah, I think that's all for the TA. I'll hand back the time to my colleagues for the other questions.
Thanks, Zane. Let me just try to answer as many as I can. Then we'll end it at 1 p.m. So thanks, everyone. So the higher interest rates, what's the impact on global economy? Is it always a negative? Yeah, it's definitely going to be a negative for global economy when interest rates are high. So if you're a corporate, then the first thing that will happen is, would you want to invest in any new projects if interest rates are already so high? So people will invest less. I mean, in theory, you already see it, especially in renewables, offshore wind. Renewables supposed to be the high growth area, but even then, I think like the UK, there was no one who even bidded for the UK's latest round of offshore wind farms because interest rates are just so high. So this is probably the one clear one. Then of course, if you're a very highly indebted company, interest rates are going to hurt your earnings. I guess REITs to a certain extent is also that. I mean, as a corporate, and high interest rates are going to pull down the valuations of your assets, which of course we see that in REIT. Then as a consumer, of course, when interest rates are high, you're not going to, the interest rate sensitive goods you won't be purchasing. I'm talking about homes and houses. So there is a impact across, and of course you rather save more and consume less. So high interest rates definitely going to hit global economies from a consumer and from a corporate point of view. Of course, the winner is of course banks. Because they collect cheap deposits and okay, this one Peggy, I will ask Peggy to post it on her KIT view. So sorry for that, she's in a meeting. Then any upside on LHN, when are they paying out dividend? We think they will pay a special dividend after they sold LHN Logistics. So the main story for LHN now. So LHN Logistics, which was supposed to be the depot facility where they will clean the ISO tanks, those tanks that have a lot of chemicals, that was supposed to be a growth driver, but they sold it, but they're going to get a big gain on it. So the main story for LHN is about co-living. So whether you believe co-living can grow, they have like 30% market share, I think, based on some of the reports out there, independent reports. So we think at least for the near term, co-living definitely going to grow well in Singapore. Firstly, they're growing capacity, I think 30-40%. If I'm not mistaken, I'm sorry if I missed some of the exact numbers. Then, and secondly, co-living also has an impact from hospitality too. Because some of their units, actually you can get it from booking.com, but you have to rent at least 6 nights. But even then, you're still talking about maybe $150 a night, which is far cheaper than hotels. So hospitality improvement actually does benefit them too. So when they have some of these events, if people can't get service apartments because it's too long a stay, so co-living is between hotel and service apartment. So they will also benefit from that. And the third thing is the valuations. I think the yield now is about 6-7%, if I'm not mistaken. And also they are trading below book of close to 49 cents or 50 cents. So that's why we still think there's upside for. But you have to believe that the co-living business will do well. Of course, they got other business like parking and so forth. Paul, considering the 3Q results and outlook for Wilmar, the share price went up a fair bit post results announcement. Are we missing something? I don't think we're missing anything. I think maybe it was just better than expected. But I don't. From the call itself, there wasn't anything like exceptionally bullish, or maybe less bad. Yeah. So sorry if there was. Sorry, I didn't notice anything in the call that made the situation bullish. As you pointed out, KIT has less cash flow than is giving a dividend. Is this sustainable? Why does KIT do so in the first place? I will let Peggy answer that, but do know that as a business trust, how the movement of loans also affect your payout. So when you do refinance, it actually raises your cash available for distribution. Of course, they still have the object. They still can decide whether they want to pay out, because they are not like a REIT where they'll pay out 90%. But most times the business trust say they will pay out everything in the distributor. So one important trait for business trust is that loan movements, if you look at the distributable income, actually affects payout. Not like REITs. REITs is not affected by loan. So imagine you get more loans, so you actually can pay more. Of course, it's not the best thing to do, but that's how REITs function as a distributable income. But I will ask Peggy to post it on the community. I'll just take one last one. Pertaining to PropNext, notice the payout ratio has been increasing since the bonus issue this year. How much do you But the DPS drop. I think they not only look at DPS per se. I think they are always if you go for some of the calls, they always mention the yield is important too, because they got so much cash, right? So I think they'll probably want to sustain it at maybe 6% or 7% dividend yield. My own view, I mean, having spoken to them before, although they not explicitly say, but implicitly, I think they have a yield target, not just a payout target. And okay, Raffles Medical, let me just clear everything. Raffles Medical price gap down, yeah, because the earnings disappointed. And because this time you really see the real earnings excluding the pandemic. But I knew we'll come up with a note later, but the earnings was a big disappointment, the third quarter update. Why short SMCI? Who are the leader in the server? I'm not sure who is SMCI. Yeah, sorry, I missed them. Is it Zain? Is it? What's this short SMCI? Is it?
Yeah, I think it's regarding trade I initiated last week. Yeah. I think just to clarify, the technical calls are purely based on TA, so ignoring the fundamentals. Yeah.
Okay, thanks, Zain. Oh, okay. I think with that, thanks everyone. So we don't have the Monday webinar because of Deepavali. But anyway, wish wish everyone happy Deepavali and have a good week ahead. We'll probably see you in 2 weeks' time when we will probably have a lot more things because of all the banking results and so forth. With that note, thanks everyone. If you do have questions, just post it in our P3 community. We'll try to answer in the meantime. So thanks everyone for your time and have a good week ahead. A good holiday break. Yeah. Thank you, everybody.